Well, hello everyone, and welcome to the last day of July 2017. Here at TradeStation, we're very excited to have in our webinar series a presenter that I know very well from my days on the CBOE floor, and that's Dan Passarelli, the CEO of Market Taker Mentoring Incorporated. I'll get it right. Market Taker Mentoring Incorporated. His firm is the leading source for option trader education. All market taker instructors are industry professionals with real, hands-on professional trading experience. Dan himself is an author, a trader, and a former member of the Chicago Board Options Exchange and the CME Group. He has written 2 books on options, Trading Option Greeks and The Market Taker's Edge. So we're going to turn things over to Dan right now. Guys, a condor is not well, it might be a big bird, but in our context, it's something else completely. We'll save that question for Dan. Our presentation is for educational purposes only. I'm not doing stand-up comedy today. All of our symbols and trading ideas that we discuss here are for demonstration purposes, and they are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everybody, and options trading itself carries a high degree of risk and may not be suitable for all traders. Now, we have posted in the chat panel a couple of different risk documents that you'll want to take a look at. First, one of them is the characteristics and risks of standardized options, and then other disclosure information. Also in the chat panel, I have posted a listing of the upcoming TradeStation events for the month of August. And we have also posted a copy or a link that will take you straight into our YouTube page so you can access all of our library of previously completed webinars. Today we're going to talk about high probability trading. As I said, Dan Passarelli is a longtime options guru. He joined the Options Institute at the CBOE back in 2005, where he began teaching basic and advanced trading concepts to retail traders, brokers, institutional traders, financial traders, and folks like us who need some counseling from a really good trader. He's also a media maven. He shows up on the Street.com, Fox Business News, Bloomberg TV, NPR, and we try to get him scheduled here on TradeStation's webinar series as often as we can. So I'll turn things over to Dan right now and get out of the way. Dan, welcome to TradeStation.
Thank you, my friend Don. Thanks. I'm glad to be here. And welcome, everyone. Welcome to the audience. I'm glad that you're here as well, because otherwise I'd be talking to nobody except Don. We're going to talk about high probability trading today. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by calling 1-888-OPTIONS. Okay, first of all, I want to shamelessly bribe everyone in the class here today to like my presentation. So please, by all means, go to markettaker.com/ebook. That's markettaker.com/ebook. And I would love to give you for free 3 secrets to making money in any market using options. This is a book, an ebook that I wrote, and it's short. It's not like 300 pages or anything, but not too short, long enough to get the point across. It's a book that I wrote with a little bit of help from John Kamisic, who's the head coach at Market Taker Mentoring. He's great. He's a former Goldman Sachs guy. You'll love John. And he helped me out a lot with this book too. So go to markettaker.com/ebook and pick me up on this. It's yours, free. Okay, high probability trade. So let's talk about something really, really important here. First of all, option trading is not about predicting where the underlying stock price is going to go. Now, for people who are newer to trading, that might seem kind of crazy. Like, of course, it's revolves around trying to predict the underlying stock price. How else are we going to make money? We have to have some sort of opinion, don't we? That's how trading works. You make an educated analysis of where the underlying stock price is going to go, and you use options to trade it, right? Isn't that how it works? Well, not really. That's a very, 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 very small part of it. What good option trading really is about is using quantifiable statistical measures to predict potential profits and optimize risk reward. So I like to use the analogy here that you're not trying to be a gambler, trying to guess what's going to happen in the future. You're trying to be the casino by maneuvering in this game of unknowns and managing uncertainty by using statistics and some simple math tricks and that kind of thing. So I want everybody in here to have the mindset that you're not gambling, you're not guessing, you're a casino, you're a statistician, you're an oddsman. I think if you have that as an attitude, you've got half the battle won right there. All right. So one of the best ways to trade it in this regard and put on high probability trades is to use income trades, which are a family of option strategies that benefit from time passing. So how do you benefit from time passing? Well, simple. As time passes, options lose value, all else held constant, phenomenon known as time decay or erosion. And we're going to put that to our advantage by using and engaging in option selling strategies. Effectively, to put it into really simple base terms, we want to sell high and buy low later. All right. So the quintessential sort of basic amino acid of this organism called income trading is the credit spread. And there are two types of credit spreads. They're call credit spreads and put credit spreads. A call credit spread is when I sell a call and buy a higher strike call with the same expiration on the same underlying. Put credit spread is when I sell a put, typically out of the money, and buy a lower strike put with the same expiration on the same underlying. So these are option selling strategies. Now, I know we're buying one option, selling a different option, but effectively, the operative option in this two-legged strategy, either one of these two-legged strategies, is the short option. The short option is where the trader will make or lose money. That's the trade. The long option is the risk limiter. It's how we control our risk in case anything like a black swan event or a Six Sigma event happens where there's a highly unexpected event and, if we're selling naked options, we can lose a whole lot. So, and don't get me wrong, selling cash secured puts can be an excellent part of any investment, long-term investment strategy. But for trading, I like to trade with very, very controlled risk. And this is a very professional, time-tested way to do it. All right. So let's look at an example here. This is Mobileye. MBLY. And this is a while back. This screenshot is, I don't know, from 2 months ago maybe. So there was some support here in Mobileye. And that is the first step in identifying a potentially good credit spread. We want to find support or resistance. So in this case, we had resistance and resistance became support. So there's step one. Now, I'm just going to kind of cut to the chase and skip over, for now, some of the other steps. We're going to revisit those later, but I want to show you the specific trade that we actually talked about this trade in our daily group coaching class. We gave this away as a trade idea to our students. we sold the March 45.5 puts and bought the March 43.5 puts. So support was something like 46. So in class, we talked about selling the 45.5 puts, which is a little bit below support. That's key. That is an essential part of putting on a good put credit spread. And then we skipped a couple strikes. Why'd we skip a couple strikes? We'll get to that. And bought the 43.5 puts for 15 cents. All right. So that's our put credit spread. We end up with something that looks kind of like this. This is sort of a graphical diagram where if we put that trade on at the price that we were talking about, so sold the March 17th 43.5, 45.5 put spread for 30 cents. And if we were to hold it all the way until expiration, which to be fair, we probably wouldn't hold it all the way until expiration. We'd probably close it at an opportune time. And we'll talk about that in a minute too. If we put this trade on and held it all the way till expiration, the stock Mobileye was at 47.38 when we put it on. So basically, one of a couple of things could happen. One, stock could go up. Two, the stock could stay basically where it is. Three, the stock could go down. So let's first look at the scenario where maybe the stock goes higher after we put this trade on and is trading above 47.38 at expiration. Well, if the stock is above, actually if it's anywhere above both of our strike prices at expiration, what happens to these puts? For those of you guys who are novice traders, this can be a little bit of a tricky question. For those of you guys who've been trading for a while, this is a very easy question. If the stock is above 45.5 at expiration, what happens to both of these puts? Don't be shy now. Okay, good. There we go. There we go. Right, they expire worthless. They lose value, they expire worthless, and yes, you get to keep the cash. So basically, if Mobileye is anywhere above 45.5 at expiration, we hit a maximum profit of 30 cents. So, okay, let's visit our three scenarios. Mobileye is higher than 47.38. Well, if it's higher than 47.38, it's higher than 45.5, so we make our maximum profit. If Mobileye stays pretty flat and stays close to 47.38, well, then it's still above 45.5, and we make our maximum profit of 30 cents. If Mobileye falls and is below 47.38, well, if it doesn't fall too much, we still hit our maximum profit. The stock can fall like $1.82 or something like that, 70, 62, whatever it is. And we still hit our maximum profit. So the stock could go up, stay where it is, or fall a little bit, and we still hit our maximum profit. So this is the definition of a high probability trade. Of all the permutations that can happen, if you think about trading as a mathematician, as a statistician, and think about how prices are distributed, is how mathematicians would call it. In the Black-Scholes pricing model and any pricing model that I'm familiar with, the a priori assumption is that stock prices are log-normally distributed, so kind of like a bell curve. So the most likely scenario is that there's a small move, and there could be a big move up or a big move down. So big move up is fine. The most likely scenario is that there's a small move up or down, and that's a winner. And then if there's a big move down, then that's not a likely occurrence, but it can happen. And then that's where you run into trouble. So this is a high probability trade just by the setup. So now it's important to understand what I'm talking about here. I'm not saying, hey guys, look, I've got the secret recipe here, the holy grail, secret sauce, all those marketing words that you hear going around. That's not what I'm saying at all. I'm not saying I got any brilliant way of predicting the future. In fact, I'm saying you don't even have to worry about predicting the future if you know how to set up a trade properly so that you get a high probability of success. So I am much more likely to win than to lose here. Andreas, I'm going to answer that your earlier question in a minute, by the way. All right, so maximum gain is the credit received. Maximum loss is the difference between the two strike prices minus the credit received, which is $1.70 in this case. All right. So my break even is the high strike minus the credit received. So basically, I was saying if we're above 45 and a half at expiration, we reach our maximum profit potential. We can even fall 30 cents below that and still have a winning trade. All right. Peter, I'm going to get to that in a second too. Okay, so this is a very, very simple methodology for setting up a credit spread. This is the methodology that we teach our students in our group coaching class. This is a methodology that we use when we give our students trade ideas every single day in our group coaching class. This is a time-tested methodology that works, and in some ways is probably a lot simpler than other things you've come across. But there's one little, part that is a little bit complicated, but I'm going to show you the gist of how to do that in a minute. So what we do is we start with, I say start with direction. I guess really what I mean is start with the chart. Start with the chart. We want to find a stock that has hit support or resistance and bounced off, preferably several times. And then we're going to use support or resistance levels to set the potential short option strike. Question. We'll just call this a rhetorical question. You don't have to answer it. What is support on a stock chart? Just think about it. What is it? You may answer this question one of a couple different ways. You might say, well, it's a point where I can connect the tops, some peaks on a stock chart and draw a line, a horizontal line connecting those peaks. And if you said that, you would be correct, but that's not, I want a more insightful answer. And the more insightful answer is this. It's a point on a stock chart that it's been shown that the stock has had a hard time falling below, that the stock got down to and then bounced higher. And then to add further insight, we ask ourselves another question. Why does a stock bounce higher? Why would a stock ever bounce higher? There's only one actual answer to that question, because that's where people buy it. So it's supply and demand. You learned about that in high school. You probably forgot about it. You're sleeping in class, or I used to play poker in my math class. Maybe you're doing that or something else. The only way a stock goes higher is if there's more buyers than sellers at that price point. And then the buyers take out everything that's offered at the offer price, and then they buy more at the next highest offer price until they take out every share or contract that's offered at that offer price. That's the mechanics of a market. So wait a minute. It's not really just connecting dots on a chart, is it? That's not really what it is at all. I mean, visually, graphically, yeah, that's what it is. More information there. It's basically a map of human activity. It's a map of where the buy orders have been in recent past. Now that is some powerful stuff. Because if I know that that's where the buy orders have been in recent past, and I'm not talking about a buy order, some little old lady in Iowa wearing white tennis shoes. I'm not talking about her 50 shares that she's trying to buy. I'm talking, that's a map of the buy orders of where the big institutions were. Big money behind it. If you know that information, which you do, if there's support there, then you know, hey, there's actually somebody out there helping me make money. If I put on a credit spread with the short strike at or below support, there's actual big institutions out there defending my position. It's fantastic. So that's why we plan, I've heard a lot of crazy methodologies for setting your short strike. And compared to this one, they are all crazy. This is the one that makes the most sense. And honestly, it's the simplest one too. Draw your little line on your little chart and put your short strike at or below it. And you have a better chance of making money than any other methodology you can use. Holy cow, that's powerful stuff. But that's just the beginning of it. We're also going to move on to volatility. This is the part that's a little trickier. We want to see if volatility is elevated and only trade the credit spread if it is. Now, some of you guys were talking about delta. Delta is a helpful little rule of thumb sort of thing that helps a little bit. I will use delta to sort of eyeball chance of success. It's not a great measure of chance of success because any mathematician will tell you that the trader's definition of delta is not actually mathematically correct. But I do use it in this regard as a rule of thumb, as sort of an eyeball sort of crutch. Delta is the probability of an option expiring in the money. So albeit that is not 100% mathematically correct, it's a handy dandy little tool. Part of the reason why it's not mathematically correct is it doesn't take into account support or resistance. It doesn't take into account the trader's opinion of direction. It doesn't take into account a number of things. So here's how this works, though, just because it is a nice little rule of thumb that we do teach our students. Let's say we have an out-of-the-money call in this case. That has a 25 delta. Or actually, instead of using the example of a call, it's kind of a coincidence here. This put that we're talking about actually did have about a 25 delta. So let's just say we're looking at an out-of-the-money put with a 25 delta because that's what we have right here on the screen. That means it has a 25% chance of being in the money at expiration, which is where we lose money. So it has a 75% chance of being out of the money at expiration, where we make money. So we have a 75% chance of making money. Now that's a little bit of an oversimplification. Again, it's not 100% mathematically accurate. It doesn't account for some important things. And specifically what this would mean is a 75% chance of hitting our maximum profit, because our break even is actually below there. All right, so nice little tool. So look, the 45 put has a 25 delta. Oops. So that means there's a 75% chance of hitting our maximum profit potential. Again, just eyeballing odds, that's all. So what do we look at here? We look at the chart, we look at the fundamentals, and we look at volatility. So the chart is what we spend most of our time looking at. As far as the fundamentals, all we care about are volatility events. We don't care, I don't care personally about looking at financial statements and all of that. If you're a CPA or a CFA or something like that, you might have better insights than some people in financial statements. But you've also gained the insight that no matter how good at reading the financial statements, for short-term trading, a whole lot of things can happen that wouldn't make logical sense if you're looking at financial statements. How many of you have ever said, oh, well, on earnings, I think the stock is going to go higher because the analyst consensus is they're going to make 20 cents a share. And then what happens is the news comes out, they actually made 25 cents a share and the stock goes down. How many of you have ever seen that movie before? If you've been trading for more than a year or two, you've seen that happen. It happens every single earnings season, where it looks like they beat estimates and it still goes down, or it looks like they didn't beat estimates and it goes up. So I don't care to try and predict earnings usually. I don't care to try and use financial statements to predict short-term trading. All I care about fundamentals is when the volatility events are. When are earnings? When are other big news events scheduled to be announced? Because the one thing I know with the credit spread is that bad move or big moves are bad. Now, with the put credit spread, if there's a big move up, that's great. I'll make money. But if I'm really looking for a big move up, selling a put credit spread would be a foolish way to trade it. I'd rather buy an out of money call or something where I can make a hugely leveraged profit instead of making a measly 30 cents on like a 20% move or something, right? And of course, a big move down is where I lose money. So I don't want to have a credit spread going into earnings. If earnings is coming out before my credit spread expires, I'm making a mistake. I want to make sure that I select an expiration that happens before earnings. Always, every time. And then the volatility chart is important. I'm going to give you a crash course here. I mean, volatility is somewhat complicated. It's one of the things that John, our head coach, talks about in our group coaching class every single day. He uses the volatility setup because that's where you get the most edge on your trade. I'm going to give you a crash course in it. I'm going to show you the important things, but there's a lot to it. So we're mainly looking for two things, really three things. These are the two we're going to focus on. We want implied volatility to be above historical volatility today. So we look at a volatility chart and we make sure that today's implied volatility is above today's historical volatility. Now, as long as earnings aren't due soon, that's a solid first indication that implied volatility might be high and overpriced, and therefore options are overpriced and ripe to sell. The second thing we look at is that implied volatility is in the top half of the 6-month range. So Caesar, great question. How do you factor in IV percentage rank? That's bullet point 2. If you look at IV percentage rank, we want IV to be above 50%. I prefer to look at it for the past 6-month period. A lot of programs out there give you the IV rank for the past year. It's better for 6 months because the market, frankly, you know as well as I do, the market was just fundamentally different 12 months ago. And I could say that any day of any year at any time. Market characteristics change as time passes. And what was happening 12 months ago is not relevant anymore. So, okay. These are the two main things we're looking for. Again, a little bit of an oversimplification, but the thing to take away here is that we're always looking for overpriced options. You've probably heard somebody tell you the only way to make money is by selling options. And that statement is not universally true, but it is rooted in truth. Because statistically, in the long run, generally speaking, options are overpriced. Now, that doesn't mean every single time on every single stock, every single day, options are always overpriced every single time. That's surely not true. No one in their right mind would ever tell you that. But your chances of finding overpriced options is greater than your chances of finding underpriced options. So the volatility thing that I just talked about is a screen. You want to make sure that you're not putting yourself in a situation where you actually have underpriced options and you're selling something below cost, basically. You know, like you were a businessman. As a trader, you're a businessman or businesswoman. You don't want to sell below cost. You don't want to sell below fair value. You want to sell expensive things, not cheap things. You want to buy cheap, sell expensive. That's how trading works. That's how business works. That's how life works. So the only way to tell if options are overpriced or underpriced is by using a volatility chart. So volatility charts are very key. They're your new best friend if you haven't been using them. Peter says, do you trade options when they're cheap? Well, I might consider an option buying strategy if options are underpriced, if they're cheap. I certainly would avoid, like the plague, selling options if they're underpriced. Because then you put yourself at a statistical disadvantage. You might still make money, but you're at a statistical disadvantage. You become the gambler, not the casino. Rich says, but if volatility is high, we make more from writing, but we lose more when buying the other part of the spread. This should cancel out, right? Great question. Actually, no, though, because of Vega, because closer to the money options have greater sensitivity to volatility or higher Vega. Farther out options are going to have a lower premium, so we're not paying as much for them, and they have a lower Vega, so they have less sensitivity to implied volatility changes. So basically, and another way to look at that, well, let's just stick with that. So yeah, you're selling one option that's overpriced and buying one option that's overpriced, but because the option you're buying is less expensive and has less exposure to volatility, what you gain by selling the overpriced option more than offsets your detriment of buying the other overpriced option. Okay, cool, awesome. Okay, so let's talk about this, and I'm going to take more questions. You guys have really great questions. How often can you look for income trades? How often can you expect to find good income trades? 3 words: all the time. Now, to be fair, some market periods are better than others, but you can search and, in my opinion, find great income trades every single darn day. And there's simple steps. We went through them all. I mean, credit spreads is one of the easiest trades you can make. I kind of gave you the crash course here. I mean, there are some nuances to it, but it's kind of simple. Look for support and resistance, analyze the volatility, avoid earnings, do all the things we talked about here. Today we talked about how to generate consistent, predictable income, the 3 analyses you need to set up winning trades. Talked about a couple of traps you can get into. Didn't have time for every single thing there is to get into, but I am going to take some more questions in a second, so we can talk about all these things. But before we do, let's talk about how to take money from the market right now. This is a simple process that I want to walk through together. I want to share this with you. I truly believe that anyone can take money from the market with low risk. The only problem is, honestly, most people overcomplicate. So we rolled out, several years ago, we rolled out the Market Taker Live Advantage Group coaching class. This has become our most popular class. The students in this class love it. In this class, I'm going to share with you all the techniques we use at MTM. Set up credit spreads, time spreads, iron condors, like we were talking about earlier, butterflies, and more. So that you can stop guessing and risking your hard-earned money on bound to fail trades. And so you can generate consistent income. Now, in this class, the group coaching class, it's live, but it's recorded. So all the videos are all on demand from recorded classes. The live component is every day from 9 a.m. to 10 a.m. Central Time. That's 10 to 11 Eastern Time. Again, Over half the people who are in this class don't attend live. They watch the recording, so don't worry about that. You don't need any special software to attend this class. If you've got a TradeStation account or any options-friendly brokerage account, you'll be just fine. You've got all the tools you need. This class is good for ETFs, stocks, indexes, everything. And if you sign up for this class today, and I'm actually going to give you a special trial price, almost free with the processing charge. You're going to get over 25 hours of class time, an everyday class. So here's what I'm going to give you today. 1 month of group coaching, which is normally $332 a month. For those of you guys who are beginners, I'm going to give you the Options Impact Series videos. I'm going to give it to everybody, but it's great for beginners. That's a $497 class you're getting free for today. And I'm going to give you the MTM email hotline. On our website, we sell that for $1,000. You get a month's access, unlimited email access to this for $1,000. So this is an $1,800 package. Today, you're going to get it for $49. Basically free with this is a processing charge because we got to make sure that you get all this stuff. Go to markettaker.com/49. markettaker.com/49 right now, and you are going to get this trial for free today. Now, once you do, go to markettaker.com/49. You're going to get immediately sent a website to log into, a username and password, so that, you can start out by watching today's class and see what trades you talked about today. You can start out watching the Options Impact videos and using the email hotline. So again, go to markettaker.com/49 and we'd love to invite you into our class. Now, I'm going to take some questions. The first questions I'd like to take so we can get it out of the way are, do you have any questions about this special trial offer? Oh, I know a question that somebody's going to ask because somebody always asks this. After the first month, what happens? The logical thing that you would assume is, okay, so Dan's trying to hook us in here and then it's going to be $332 a month. That's not what's going to happen. Something much better than that is going to happen. Now, first of all, I will say, we've got a lot of people who pay, it's actually $1,000 a quarter, which comes out to $332 a month. We've got a lot of people who pay that. And they pay it because what they do is, in this class, John gives you trade ideas every single day. He gives you about 10 actionable option trade ideas every single day. And when he gives you those trade ideas, what happens is a lot of people trade them. And if you make money on 1 or 2 trades, it can easily cover $332 a month. And then you've got another, month worth of trade ideas that you're going to get. So at full price, it's worth the cost, but you're never going to pay full price. If you sign up for this $49 trial today, after the first month, you're going to renew for life for as long as you want. You get to keep a 40% discounted renewal. You renew at $99 or $199 a month for life if you want. You can cancel anytime. You can sign up for this class and cancel after a couple weeks and you never get charged anything after this. But if you decide to stay in the class, like imagine you join the class today and you pay $49 today, you go in the class tomorrow and John shows you this credit spread and you think it looks good and you trade it and maybe you make $400 off it. Okay, great. And then maybe later in the week, he shows you a time spread and you trade it and you make $200 off it. You're going to renew, right? This is why I offer, frankly, this is why I offer the trial price. Because I don't want you to just trust me and because anybody can tell you, hey, my class is great. But I want to entice you to try it because I know that when you try it, you're going to see how great it is and you're going to stay in this class forever. And I'm further enticing you to stay in the class by giving you a 40% off the normal renewal price, renewing at $199 a month. So this is It's what they call earn while you learn. You can be in the class. You can trade the strategies that John gives you every single day while you're learning. All the while, you're watching somebody who used to work for Goldman Sachs open up his trading platform, show you live setups, explain everything exactly to a T, what he's doing, what his trade management plan is, and you know, that's it. Yeah, thanks, Caesar. Caesar says it's a great deal, as you can see. So yeah, take me up on that. Marketticker.com/49. It is limited space, but I'm pretty sure that we've got all the. I'm pretty sure we can accommodate. We get a huge influx, then we're going to cut it off. So don't be the last person to sign up. Is the moral of that story. Do we have any questions about that class first of all, and then I'll take some general options questions, that relate to the presentation. Anybody? Okay. Do we have any questions about the content from the class itself? Uh, Caesar says, how much is your mentoring now? Well, I mean, look, this is daily coaching. This is daily group coaching. And this is your most inexpensive way to do it. I mean, we do have one-on-one coaching also, but that's 400 or $4,997, for 6 months. That's a very intensive program. If you're interested in that, you can email me and I'll put out my email after this. Manuel says, what times are these classes, are the daily coaching? They are from 9 to 10 Central Time. That's 10 to 11 Eastern. If you're out in California or anywhere on the West Coast, that's 7 to 9. So it's a half hour after the market opens and it goes an hour. Let's see here. Is this a good, how basic are the videos? So for the 1 month of group coaching, John will give you some trades that are very basic. He'll give you some trades that are fairly complex. He'll give some trades for investors. He'll give some trades for active traders. So it's mixed. That's why John gives you 10 trade ideas a day. Nobody's going to trade 10 trade ideas a day, but you're going to find 2, 3, or 4 trade ideas that fit your style every single day. And as far as the options impact video series, those are very basic. I mean, look, for 49 bucks, if you're a very advanced person, all you really want is the group coaching class and maybe the email hotline. But if you're a brand new person, then the options impact videos are fantastic for you. Andrea says, do you trade the indexes? We talk about the indexes every single day in class, indexes and ETFs, as well as individual equity. Jung says, do you do credit spreads only? No. A lot of our trades are credit spreads, but some of them are debit spreads, some of them are time spreads, some of them are, outright buying a call or put, some are selling cash secured puts, some are covered calls, some are straddles, some are strangles, whatever the market dictates, because there's always, the market's always changing. Whatever is a good trade today in the market is what we focus on. So basically, John screens the market. He spends literally hours every single day doing this for you. He spends hours every day finding the best trades out there, and he tells you what they are every day. So, I mean, nobody can make a career by doing nothing but trading credit spreads. And sometimes credit spreads are great, and sometimes they're harder to find. Let's see here. Had some older questions. Oh, also Don says, tell us about your futures mentoring. We also have a futures version of this class. which I think is, I forgot the web address, markettaker.com/futures. Nope, markettaker.com/futures49. Yeah, markettaker.com/futures49 will get you into our futures class, but that's a little different. But it's the same trial. I'll just post that link right here. It's the same trial price of 49 bucks. And that's, you get futures trades every single day. How do you scan for credit spread trades? So Caesar, in the class, John does that all for you. No longer do you have to even worry about scanning for trades. You're going to get spoon-fed the trades every single day. Peter says, problem I have with your trade example is 3/4 times I make at most 30 cents, a total of 90, but one time I lose 1/4 times I lose, right, I see what you're, okay. I see exactly what you're saying. That's why you can't really use delta as that rule of thumb, because the way the model works out, and it's partially because of the theoretical value is between the bid and the ask. You would never, one time ever in your life, find a credit spread where the payout structure is better than what the delta dictates the probability of success is. I've looked at this for literally decades, 2 decades. I've been doing this for about 25 years or so, 24 years. And unless there's a glitch in the system, you would never find a trade where the delta compared to the payout structure is favorable for you. So that should be your first indication that there's a flaw with the delta rule of thumb, because it doesn't account for the skill of the trader, chart reading, support and resistance levels, which is a viable override. So I love that you're thinking. I love that you really thought it all through. But, you know, if what you're saying was true, that would be proof positive that it would be impossible for any trader to make money in the long run, which we know is not the case, because I know plenty of traders who've made money in the long run. So good question, though. I do appreciate it. Manuel says, I find that I can't be filled if it's not a market order. I lose a lot on the spread between the bid and the ask. John, who runs our group coaching class, he middles the market all the time. There's a knack to middling the market. Like if you just put an order in the middle of the market, you may or may not get filled. There's a lot to learn about that. So you can definitely get filled between the bid-ask spread if you're good at it, if you know what to look for and what to do. You know, I used to be a market maker down on the floor of the SIBO, like Don, and you know, I'd concede my bid-ask spread all the time. But, well, not all the time, but often. So maybe you're being a little bit too greedy. Like you're never going to get filled right in the middle of the bid-ask spread. You got to give a little bit, you know. You're selling, you got to be close to the bid, buying close to the offer. You got to look at the size being bid or offered. You got to look at open interest and volume. You know, there's a lot to it. But you'll learn all that in John's class. markettaker.com/49. Caesar says, what is the maximum bid-ask differential do you consider to place a trade? Yeah, so I've been asked this questions enough times where I've come up with sort of a rule of thumb. And the rule of thumb is this. If the offer is more than 10% higher than the bid-ask spread's too wide, and it's really just not worth trading. It's too illiquid. So like if the bid is $1, if the offer is any more than $1.10, it's just not worth it. You're going to end up losing. It's not a good trade. Manuel says, in group coaching, do you give the trades of the day? Is it done before the market opens? Will it be the same as the email hotline? Oh, great question. So the group coaching is during market hours. We wait until all the riffraff from the opening rotation settles down. So we start our class a half hour after the open. So it's during the trading day. And John gives you 10 trade ideas a day. And they are all, you're able to make them all during market hour, like right then and there live. And that's why we limit the size of the class, because, if we had like 1,000 people in the class and everybody jumped on a trade, we'd move the market, so we're careful to limit the size of the class, and that's why we have to cut it off if too many people enroll. So again, for those of you who are thinking about it, basically spend the $49 now before you miss your opportunity, because it is possible that we fill up. He just said, I'm in. Awesome. That's great. Welcome. And let's see here. Feel like I went through all the questions. Do we have any other questions, about anything we covered in the class? Andrea says, what are the keys you look for exiting a trade that moves against you? Yeah, so good question. I mean, setting up a trade so that it's statistically sound is really just half the battle. That sets your probability of success and payout structure and sort of locks it in. But how you manage the trade determines if you make or lose money. So if the trade moves against you with the credit spread, I have a rather simple rule of thumb. If the underlying goes through the support line or resistance line, if it's called credit spread, if the underlying goes through the support or resistance line, well, then the premise of your trade is no longer valid, is it? Because the whole premise of your trade is that, well, I think support's going to hold. So if it goes through support or resistance, or if it goes through your short strike, close or adjust. That is our rule, and I think it's a pretty darn good rule. It makes the most sense, right? Jung says, do I need a promo code to apply for the trial? No, that is already the trial price. Just go to marketticker.com/49, and it'll come up as $49. So no promo code even needed. I bypassed that and actually set it up so that it just automatically defaults to $49. What else? Other questions? Any other questions? All right. Well, I'm glad that everyone was able to join me. I went through kind of a lot, and am really super happy to offer this trial to you guys because, I mean, everybody says, hey, my class is great, but, I don't want you to just leave me. I want you to be able to try it out. So please take me up on that, marketticker.com/49. And again, thank you guys for all being here, and thanks for all the really great questions that you guys asked. I hope it was really helpful. I feel like we did cover a lot of ground. So trade well. If you guys have any other questions at all, I would be totally happy to help. You can email me, dan@markettaker.com. What we do at Market Taker is we help people become better traders. So if you have any questions about option trading at all, we are super glad to help you. Thanks, everybody. Have a great day, and we'll see you in our next webinar.